Janelle, for my first startup, I pitched over 100 investors for capital. How much capital do you think I actually brought in from that fundraise?
I don't know, maybe 250K?
No, zero. No one said yes to me.
Why am I not surprised?
The good news, though, is that I was able to get well over $250,000 to get started with my business because of none other than non-dilutive sources of capital.
This episode is all about non-dilutive alternative sources of capital. Prior to my role leading partnerships with Hustle Fund, I was a leader at a revenue-based financing firm called Flywheel. So this topic is close to my heart. Eric, as a VC, we have a vested interest in providing venture funding to startups. However, you were a bootstrapper. What did you learn in your journey as a founder who didn't go down the venture route?
Okay, well, it wasn't by choice necessarily because I did try to get some money, but it does turn out that there are so many better sources of capital than venture financing. And it pains me to say this as a venture capitalist, but it is absolutely the truth. The problem with venture capital is that when you take the money, you're going to give up ownership as a founder. And while it may not seem like that much ownership at the moment, this could be tons of money when you IPO or exit a little bit later down the line. We won't have time to cover all the forms of alternative financing, Janelle, in this episode, but there are definitely some options that are pretty awesome for founders to consider.
Right. So let's try to cover a few. So we're going to highlight the value of bootstrapping, new lending models, crowdfunding, government programs, and going to the bank for a line of credit. Let's start with bootstrapping.
So bootstrapping, absolutely my favorite. The idea here is to not raise any capital ever and just make money and profitably grow your business. So if you have a path to do this, Janelle, I think this is the absolute gold standard for running a company.
Yeah, but it tends to also slow down founders a bit when you have to overcome the chicken and egg problem for having to come up with enough cash to get going, right?
I think that's really fair. And, it does help to have a little bit of a nest egg to get going. And that is a chicken egg problem. But the good news is that there are new lending models to support this problem. In fact, didn't you speak to one of our founders at Hustle Fund, Kayla Worthen, who runs Paintbrush, about this exact issue?
Yeah. So Paintbrush is a great example of our second category, that alternative lending model. So check them out at getpaintbrush.com. What Paintbrush does is they offer $50K loans to really early stage companies, which was surprising to me as someone who's worked in RBF. This is idea stage funding. They will underwrite founders based off of their previous experience as operators. And this definitely helps crack that chicken and egg problem. And speaking of RBF, revenue-based financing, that's something else that's worth considering. This would be something for founders a little bit later down the road when they actually have revenue to get a loan off of. So, Eric, what about crowdfunding?
Yeah, so crowdfunding as an option is an interesting one. And there's certainly some established crowdfunding platforms like Kickstarter, GoFundMe. There's a lot of other ones as well. I do like crowdfunding, but only for certain kinds of companies. I tend to think that they work best for consumer products. So for example, Janelle, if you and I were trying to pre-sell a huge order of custom black ceramic mugs, let's say, getting that capital upfront from our customers before we deliver is pretty sweet. And if that just means putting up a landing page with a cool video and some cool mugs as pictures and we get all this money, that's awesome. However, I'm not so sure this works as well with, let's say, like an enterprise SaaS company or other categories of business as well.
All right. What about a different option, like the government? Do they have capital for founders?
Actually, they do, Janelle. In the United States, there's an agency called the SBIC. It's been an awesome traditional lender for small businesses of all types for many, many years. And a lot of founders in tech seem to forget about them. You have to apply and there's like an application process, but I hear it isn't too bad to get through. And you can get some pretty substantial loans and on terms that are pretty good. Other countries like Canada also have their own programs for founders. In Canada, for example, there's a program called Shred. And we have seen some of our Canadian founders receive millions of dollars of non-dilutive capital from the government to provide that kind of assistance for founders. So if you're in the United States or outside the United States, it's definitely worth a few ChatGPT prompts to see whether there's some options in your local area or even your city or municipality that might be able to fund your company. So Janelle, I got to ask you about that last category that we mentioned, which is maybe one of the most obvious places for non-dilutive money, going to a bank.
Yeah, so this might not be the easiest option on day one, Eric, but if your company has a little bit of traction and history, then it certainly is possible to apply for a line of credit from a bank. They look at your business history, annual revenue, business plan, pretty traditional, but it is an option.
This is so old school, Janelle, but I swear it does work. And I know, in fact, that it does work. Fun fact, about 15 years ago, I had finished a bowl of ramen for about $8. And I decided to walk home. And on the way home, there's a Chase Bank branch. And I looked at it. I say, what the heck? I'm just going to go in there. And within an hour, I walked away with a $250,000 line of credit. It was that easy. But I did have some traction metrics at that point that made it that easy.
Okay, so we talked about a few good non-dilutive options here, but how does a founder know when an alternative form of capital is appropriate?
That's a great question. So my take is that these alternative sources of capital are usually preferable than venture capital. If you can get access to these products on good terms, then you should go for it. But be careful about personally guaranteeing anything. You may not have a choice sometimes, but be aware that some forms of alternative financing require you to personally collateralize an asset you own, like your house.
All right, founders. First, a big thanks to Kayla and the team at Paintbrush for inspiring this episode on non-dilutive forms of capital. You should check out their website at getpaintbrush.com.
And if you like the content that we're making here at Uncapped Notes and Hustle Fund, we encourage you to sign up for our Founder Playbook newsletter as well. We're going to flash that information on the next screen in just a moment.
See you next time.